see here. It says I'm live. What's up, guys? It's Larry, the mortgage guy, your mortgage insider. And I'm very excited to bring to you my first time homebuyer deep dive weekly class. So what I mean by that is I usually do a first time homebuyer webinar or seminar where I kind of go over the details about the home buying process. But it's really hard to get really deep into the details that I go over. So the purpose of these classes is to literally break down what I teach in the webinar or seminar form, but I actually will break down a particular topic or detail in that class so that we can get really, really granular on the information that I provide. So I'm going to go ahead and share my screen. Let's see here. All right. And that, I don't even know what that is. Oh, notifications. Sorry about that. Hopefully you guys don't see like notifications you're not supposed to see. Maybe I should switch screens here. Let me go and switch screens here. I'm going to hide my screen again so you guys don't see. Appreciate the patience as I get my shit together. I don't know you guys see notifications because I do get notifications from teammates and clients and such. And I don't want you to see the private information, right? So I probably should just use a different computer when I do this thing so that you guys don't see anything. All right, so I'm going to share my screen again. Hopefully you guys will see the new screen, right? Can you guys give me a thumbs up or hello or whatever? You know, just say something that you can see my screen. Why is it not presenting? There it is. Perfect. Thank you very much. I'm going to make sure all the participants are invited to talk or participate. Oh, I did not mean to do that. I just removed permission to talk from someone. I don't even know why I did that. That was my bad. If you're trying to talk and you got permission removed, let me know and I'll change it. I'll fix it for you. Okay. All right. So now that we are together, I want to again welcome you to my first time homebuyer deep dive class that I do every single week. And of course, the whole idea is this is for you guys. So if you have any questions, if you are confused about something, if you want me to slow down, please stop me. I don't want to leave anyone behind. I want everyone to leave this class with all their questions answered. Okay. And I have a lot of time to stay here long enough to hopefully take care of that. Okay. All right. A quick introduction. My name is Larry Lee. I'm a certified veteran mortgage advisor and I'm a branch manager of the Larry Lee team at Van Dyke Mortgage. I'm a licensed loan officer since 2016, which is 6 years, which is kind of mind blowing because I thought it was less than that. I even make a joke where my wife and I were talking to someone and I told him that she's been in the business for a couple of years and she was like, it's been like 5 years. I'm like, holy shit, because that means I've been long in the business longer than her because I was the one who brought her in. Okay. My side hustle, I'm a social media marketing coach and I run my own ad agency, Robots LLC. The reason why I bring that up is because I'm kind of marrying the two businesses or the two passions I have, which is, of course, the mortgage business as well as the social media to sort of try to bring this kind of content to the general public. That's why you guys are here. Okay. I am licensed in 11 states, Arizona, California, Florida, Illinois, Indiana, Louisiana, Michigan, New Hampshire, North Carolina, Tennessee, and Texas. All right. My mission is that I love the mortgage business, but I was fed up with the lack of education and information clients were provided during the application process. So I created a first-time home buyer coaching class for mortgage clients that provides instant access to answers to questions and simple explanations to the mortgage process and how to qualify. And what I mean by that is I want people to be able to search for information and find it immediately. I don't need them to opt in. They don't have to tell me who they are. They can literally find the information and read it for themselves. That's the whole purpose of what I'm trying to provide. Okay. Because a lot of lenders are kind of stingy with their information or they don't give you full clarity or they're just not good at explaining. And you have to ask them for clarity. And I'm trying to make it so that you don't have to ask anybody. You can find it and it's there at your fingertips. Okay. I also provide one-on-one coaching for those who do want it, but of course you are required to engage with me if you want one-on-one coaching. Otherwise you can ghost me and block me and make it so that I can't find you, but you still consume the content that I provide. Okay. Unlike other loan officers, I made it my passion to coach first-time homebuyers on the mortgage process. And that makes all the difference on how I've helped hundreds of people get on the right path to home ownership, with many of them becoming homeowners. You remind me of many of my smart, successful, and savvy clients who are homeowners because you are taking the right step on the home purchasing process like they did. And what I mean by that is you're looking for information, you're looking for content and education about the home buying process. That's why you're here, right? The home buying process is very confusing to most people, but that is why I am here, to simplify this process and make sure you're 100% prepared in the home buying process and to become ahead of the competition. Now, before I move on, I do want to share a link to my audience who are, hold on one second here. How do I get out of that? Okay. I have a link that I share to people who are watching on StreamYard just in case they want to get into the Zoom. So I forgot to do that. Let me do that real quick. Send on StreamYard chat. Let me copy that. And just in case they are watching and they want to get on the Zoom, they can ask the question. I'm going to share the link. Okay. So I just did that. All right, cool. Back to my presentation. Appreciate you guys' patience as I do that. Okay, so my why, of course, my wife and children, I call my 3 boys the Lee boys, and I'm specifically focusing on Hunter and Bruce on this slide because they are both nonverbal on the spectrum for autism, and my goal is to develop enough resources to provide them ABA therapy. I've been told by many parents that I trust who have children on the spectrum for autism that it is a game changer and has helped the development and growth of their children. So I definitely want to provide that for them. So that's my goal for this year. I'm also passionate about helping veterans, and I'll explain to you why in the next slide. Okay. This is a post I put on social media. It's a post that got a lot of likes and a lot of comments, and I'm not really serious. In fact, I might be considered unprofessional on social media, but this is one of the posts that I was really serious about. Okay. My father was living in Da Nang, Vietnam during the fall of Saigon. My mother lived in Saigon. My father left by helicopter, my mother by boat. It was U.S. soldiers who helped them get in the helicopter and on that boat. They met in Hong Kong, China. If it wasn't for a U.S. soldier, my parents may not have survived, met, and had me. And I would have what I have today. I might not even exist. Those U.S. soldiers are more than likely veterans now. So thank you, vets. I owe you my life. And I really do feel I owe a debt of gratitude to veterans in general, because, again, if it wasn't for them, I wouldn't exist. Okay. All right. So again, I do a first-time home buyer seminar where I talk about I give honest answers to top 10 home buying questions, and I talk about questions that loan officers should be asking when they're taking an application, and top 5 things not to do when buying a home. I'm not going to be able to cover all that, but I'm going to kind of cover one of the top 10 home buying questions. Okay. Specifically, actually, hold on real quick. It's specifically, how much money do I need in order to buy a house? Okay. That's the question that a lot of people ask me, and I'm going to break that down. Okay. Disclaimer, I'm not trying to piss anyone off or make anyone feel stupid. I am not simply trying to provide transparency because most loan officers are doing a horrible job of telling you the truth. Also, any information I share is general knowledge I acquired through training and experience. Every situation is subject to a case-by-case basis, and exceptions are always possible, especially with different lenders and financial institutions and states. All right, so again, the question is, how much money do I need in order to buy a house? And this is probably a question that is going to be the most complex to answer because it involves so many different variables, and it really depends on the loan product. It depends on where you're buying. It depends on your current situation. So to answer this question over a phone that someone found me on Google is literally impossible. Okay. It's easier to answer once we get an application and we look at what you're working with, and we can structure the loan is what they call it, and we could figure out what fees and what costs and what sort of down payments and such you need to provide, cash to close is what we call it, in order to close on your home. Okay, but I'm going to attempt to give sort of a 30,000 foot view, overarching general answer to this question. Okay, so the first one should be the most obvious, is down payment. Okay, you need down payment for your house most of the time. Okay, if you're going to buy a conventional, you need to have at least 3% down for a home ready or home possible. A lot of people don't know about this. It's not a first-time home buyer loan. It's just a loan that's designed for people who are a part of a certain income bracket, right? Like there's an income limit. You can't make too much money. You have to be around the median amount. And there's a formula that you have to apply, or there's like a chart that provides that information. But you can possibly qualify for a conventional loan and only put 3% down, which is cool because a lot of people go with the FHA because it's lower than the conventional, meaning it's 3.5% instead of 5%. But if you can go with the 3% conventional, why not? Especially since in this market, conventional is a little bit more popular, unfortunately, but that's just how it is, right? So it's called the Home Ready or Home Possible. If you don't know about that loan, you should look it up. It's pretty cool. And I don't see why you wouldn't go that route if you can qualify conventionally. Okay. 3.5% for FHA. That's standard across the board. I think most people already know this. So there's nothing to really talk about that. 5% is normal for conventional, right? And again, people think that you must put at least 5% down to go conventional, but you can go as low as 3% down. But 5% is normal, okay? But it's not a home ready or home possible, meaning there's no like limitations, right? So a limitation would be, let me go and close this out because I don't want any more information to be sent. A limitation would be like income limits, right? You would have income limits with a 3% conventional home ready or home possible, but you don't have an income limit for the normal conventional, okay? People tend to think that you need to put 20% down when you're buying a home in general, but that's not really the case. It's just kind of the rule of thumb or what's popular. And the reason why is because it allows you to avoid mortgage insurance. Okay. So again, 20% down, it is ideal in most cases if you can put 20% down because you don't have to put, you don't have to pay mortgage insurance, but it's definitely not required. And sometimes it's not the best way to go about buying your house, especially if you have that much funds. Okay. And I'm going to actually talk about that later on. Okay. For VA and USDA, it's 0% down. Now, the way that works is, of course, the VA, you must be a veteran that qualifies. There are certain things about that. And USDA, you're more than likely going to end up having to purchase in a rural area, meaning not as developed. Someone just joined, so I'm going to add them in real quick. Let's see here. I'm going to go ahead and promote the pay list. I think you already added. Okay, cool. So, with USDA, what they're trying to do is they're trying to encourage growth in home ownership in less developed areas, right? So in order to entice people to do that, they're willing to allow you to purchase the home without any money down. But of course, there's limitations, credit limitations in terms of scores and certain details about your credit, as well as income. You can't make too much money again, right? And of course, people might be like, well, why is there a limit? Well, they're trying to help people who don't have as much income, right? So yeah, that's how USDA works. Okay. And they're both government loans. So they're going to have possibly additional layers of expectations in order to qualify for those homes. Okay. But those are basically the bread and butter, I would call, or the normal loans that you might hear about that most lenders are able to provide in terms of their down payment. Okay. So conventional 3%, 3.5% for FHA, normal conventional 5%, and then 20% down for, if you want to avoid mortgage insurance, and then 0% for VA and USDA. Now there's other loan products out there. I'm not going to really talk about those, okay, because that's really for another conversation. But if you really want to know about it, if you're buying like an investment property, you have to put like 20% down. If you're buying a second home or vacation home, that's like 10% down. The numbers might be different. Numbers might be changed. I might be giving you the wrong numbers right now because a lot of things changed a lot in the last like quarter. When I say quarter, like a couple months, right? But again, I'm more talking about first-time home buyers who are buying for their own personal primary home. Okay. Now let's talk about closing costs, which is probably the more complicated, less talked about, less explained part of the home buying process and what you need in terms of funds. Okay. So I'm going to just show you the other slides. There's more than just what's on this page. Okay. See, I'm going to show you so you can see how much is involved. Okay. And when you go through your loan estimates or any kind of disclosures, you're going to see a lot of itemized fees, and it's going to be really intimidating. And it's going to be like, what is this and what is that? I want to start off by saying not all of it is for the lender. Some of it is for other third parties who are involved in the home purchasing process, like title, like attorneys, like appraisals. You gotta get ready for insurance for your home. You gotta get ready for taxes for your home. So there's a lot of different things that are involved, and no matter what, you're gonna pay all this. It's just that as the lender, we try to make it as easy as possible to buy a house. So we try to manage all that for you. Okay. Let's pretend the lender didn't exist, right? Let's say you're buying the home cash. You're still going to pay a lot of different fees. You would just have to figure out who to pay and how to pay. And title will probably be able to help you with that. But without the lender involved, you don't have that middleman trying to get things together for you. Okay. Or there was probably a time in the past where you had to pay these fees separately on your own. Like you would, buy a house and then you would get a bill from this person, a bill from this person, or the title person would be like, well, you got to go and pay this guy first, get a receipt, and then give it to us, and then we can close you. It was probably like a really, really complicated, like almost like an endeavor, like a project. It's almost like being a general contractor and having a bunch of subcontractors that you have to hire and pay for. That's really what this is. Okay. So the reason I'm bringing this up because I think a lot of people think that when they look at the loan estimates or the fee sheets, they're like, holy crap, this lender is like charging me a whole bunch of crap. That's not the case. There's a fee for us, the lenders, but there's also fees for everyone else that's involved. Okay. So if you look at this part, I'm talking about closing costs without taxes. Right. So what I mean by that is I'm giving you an estimate of how much you're going to be expected to cover that doesn't involve your property taxes or anything else on the side like that. Okay. So lender fees, which can include an application fee, which is when you apply, right? And that actually might be like your credit pull. Okay. Prepaid interest, because we have to figure out, interest is always going to be paid no matter what. We have to figure out when you're going to purchase, when you're going to close. We have to calculate like the interest, because you might not be paying your payment until up to 59 days or longer, right? Because you get to skip, and that's probably a bad word to use, but you get to not have to make your first payment on the first of the incoming month. You get to make it on the next incoming month. So let's say I close the house today in February. I don't have to make my first payment in March. I get to make it in April, right? But there's still interest there they got to pay, right? So you got to be prepared to cover that, okay? Points to reduce interest rate. This is something that is popular to do if you are interest rate sensitive, you're payment sensitive or whatever. You can actually buy down the rate. This is a totally different conversation, but the idea is that if you have an interest rate that you want to lower, there's a possibility that you can actually pay the lender to lower that rate. Okay. It's called a discount point. Again, that's a whole totally different conversation, but it's a possibility, and that might be part of your closing cost. Okay. Origination fee or loan fee. Origination fee might be something that they add on because of the service that they're providing you, right? I know some lenders, I'm not going to mention any of them, that might charge like a percentage, and that would be their origination fee, right? We don't charge a percentage. We charge, for the most part, underwriting and processing, which I was about to get to next. But we don't have an origination fee, okay? But some places do have an origination fee. And of course, you'll hopefully be able to see it. Is pretty obvious when you look at the loan estimate or your initial disclosures. Okay. But yes, that is a possible fee that you might be paying. A broker fee, that is if you are involving another investor, right? Underwriting fee, like I said, processing fee, these are going to be parts of your loan process that needs to be done. You need someone to process your loan, and you need someone to underwrite your loan. There's a fee for that. But some lenders might not charge an underwriting fee or a processing fee. They charge an origination fee, which kind of covers that. Okay. So even though they might not be outlining it to you on your loan estimate, they are paying someone to underwrite your file, and they are paying someone to process your file. It just might not be on the line items that you're seeing. Okay. Mortgage insurance, that's a possibility that you must pay, especially if you're going to put less than 20% down. right? And there's a fee for that, possibly upfront. So a part of it could be something that you finance, but we're talking about cash at close, right? And then, of course, there's a rate lock or rate lock extension fee. Okay, with the rate lock, that would be a part of the pricing, but a rate lock extension fee is if the rate were to expire or it's about to expire and you need to extend it. I don't want to get too into it, but the whole idea of locking a rate is to make it so that your rate is not subject to the market changing, whether it's for the positive or for the negative. You're just saying, I'm comfortable with this rate and I want to stay the same no matter what happens. And you can only lock it for a certain period of time. If you were to take longer to close for whatever reason, then you may have to extend it, and that comes with a fee. And again, I don't want to get into it, but yes, you can let it expire, but it makes it so that you can't lock the rate again for another 30 days, which will, of course, extend closing for a whole month, right? So sometimes you're kind of just subject to paying the extension just to keep that lock that you originally had alive, right? Again, so I don't want to get too deep into it, but I want you to know that what these fees are. And in general, from my experience, okay, again, I might not be talking about or speaking for everybody. From my experience, it's anywhere between $2,000 to $4,000. And normally I don't have origination fees with the place that I work. So it's not really a percentage of the loan. It's more fixed fees that are pretty much across the board with every loan that I do. Okay. So that's why I'm giving a number out there, 2,000 to 4,000. This is, again, not including taxes. Okay. Taxes is going to change everything. Okay. Now I've been hearing 5,000. That might be a possibility with the market and how things are changing. Who knows, right? But I just want you in your head, if you're like, I got $1,000 in the bank, I'm ready to go buy a house, you don't even have enough to cover closing costs. Okay. And you might want to try to get concessions like from the sellers or help from the lender or whatever. In this market, good luck with that. Okay. But yeah, I just want you to come correct, right? And 2,000 to 4,000 is probably a good indication of what you really should be expecting to bring to the table. Okay. And Facebook user said, let's go. I don't know who that is, but thank you for the enthusiasm. I'm going to go and highlight you. And maybe if you sign in through StreamYard, I can see your face and who you are. Okay. All right. Next slide. Closing costs again without taxes. Continued. See, we weren't done yet, right? You got title search, lender's title insurance, borrower's title insurance, appraisal fee, meaning you're paying the guy or gal to come and look at your house and give you a value, right? Attorney fee. For Texas, we are attorney state, so we require an attorney to review the documents. Okay, that costs money. Pest inspection fee. That's something that you might not require. For the VA, you definitely require it. Okay. Flood hazard determination fee, probably in flood zones, right? Credit report fee. I talked to you about that. You know, there's a cost to pull your credit. Settlement of escrow, agent fee, deed recording fee, property transfer tax, courier fee, wire transfer fee, condo certification fee, homeowners association certification fee, loan document preparation fee, notary fees, VA funding fees, FHA upfront mortgage insurance premium fees, USDA guarantee fee. I'm not going to go through all the details. This call is not long enough to cover all this, but I just want you to see what you need to worry about. Okay. And the whole idea of this class or this particular topic is you can't show up with no money, right? You can't be like, okay, I want down payment assistance and I want 0% down. What can you do for me? Well, advice, go get some money, save some money, because you got a lot of fees you got to take care of. Okay. And again, we could probably spend a whole day talking about these fees, but I just want to sort of break down other fees you got to worry about. So I was able to go over the lending fees because I'm the lender, but third party fees, I'm not even going to try to attempt to explain what these are and why they're required. Okay. You can Google it, right? Or you can talk to whoever's involved, like the title people. Okay. All right. So again, I kind of talked about closing costs without taxes. Right? Now we're going to talk about the closing cost that involves taxes and insurance. Okay. Prepaids, and a lot of people, they sort of confuse this. They're like, why does it cost? Why are you charging me so much? to buy this house? Well, some of it is fees, so there's a charge, but some of it is down payment towards your house. So you're not being charged anything. You're just literally buying equity in your property, right? So you're not being charged. You're just meeting the requirements of the lender, but that equity is still yours. It's like putting it into a bank account, so to speak, but that's probably a bad whatever. It's more like an investment. Putting money into an investment. That's probably a better way to describe it. Okay, so prepaids is kind of the same concept. I'm not saying that it's something that you're going to be able to recoup, but it's something that you got to pay, right? And when it comes to homeowner insurance and taxes, you got to pay that. They normally collect it. They collect the whole year's worth. Okay. And there's some exceptions and nuances, but they need it to be paid before you start. Okay. And I don't know if I can describe this correctly, but homeowners insurance is usually paid up front, and property taxes are paid in arrears. I don't know if that's the way you say it, but basically you pay at the end of the year. Okay. But depending on when you close, you got to get your property taxes together. You got to get your property taxes prepared, right? And the whole point of escrow, and some people do opt out on escrow, okay, but the whole point of escrow is to make sure you have the funds to pay what needs to be paid, which is required: insurance and property taxes. Hey, what's up, Henry? Okay, cool, awesome. I'm gonna go ahead and highlight you. Thanks, Henry, for contributing. Again, you have to pay these things, right? It's required to own a property. You have to pay for insurance. You got to pay for taxes. So they're going to make sure this is paid. So they collect it up front. Okay. And then you have initial escrow payment at closing, right? And again, it's pretty much the same kind of fees that you got to take care of. Okay. So closing costs doesn't just involve the fees and the down payments. There's also prepaids. And I think a lot of people don't think about this. They don't know about this. They're like, wait a minute, I have to pay for a whole year's worth of taxes and a whole year's insurance. Why? That's just the requirement. So you can't just, buy a house and then decide you're not going to pay your taxes. You can't buy a house and decide, you know what, I don't need insurance. No, you need insurance. It's not like a car. With a car, you're required to have car insurance, but no one's going to repossess your car if you don't have insurance, right? I mean, you might get a ticket, whatever, but if you don't have insurance on your home, you're basically not protecting someone else's property. Because let's be honest here, when you buy a house using a mortgage, you don't really own the house. You're kind of paying someone to finance the house that they actually own, to live in it, and eventually it'll be yours 100%, right? So in order for the investors, meaning the lenders, to protect their interest, they require insurance, because if something were to happen to the house, they need to know that the property that they actually own, right, that they are invested in, is going to be taken care of, is going to be replaced or whatever, right? So yeah, a part of home ownership is to have insurance. So this is all required. Okay. All right. So the next one is, this is me sort of trying to give you the easy answer, right? When someone asks me, how much money do I need to buy a house? Instead of me going through all of those line items, I go, you need about 10%. And they're like, 10%? I thought it was 3% down. Yeah, 3% down as a down payment for equity for your home, but you still got fees and appraisals, and you still have to get ready to take care of insurance and taxes. And you might need reserves, meaning like, let's say you barely qualify, but it's kind of like the underwriter doesn't like it, or maybe the system is not accepting an automated approval. If you have reserves, meaning extra money in the bank that you're not going to use, this money to put anything down. You're not going to use it to buy anything or pay for anything. It's just money that you have after you close. Reserves, meaning money that you can use for future mortgage payments, then that is a show of strength financially, and therefore may qualify you, right? It may make the difference. We have a saying for FHA, money solves a lot of problems, right? So let's say with FHA, you don't quite qualify, but you're like, okay, well, I got 100 months of reserves in the bank. That actually might get you approved. Okay, that might be considered a compensating factor. That might be something that the underwriter would consider to approve your loan. Okay, so sometimes the money that you need to buy a house or close a house doesn't involve money that you're going to be giving to anybody. It doesn't involve cash to close. It involves money that you have to have in the bank, right? Because the worst thing that we can do is close you on a home and you're cash poor, you have nothing, and for the next 6 months you're eating ramen, if you're lucky, right? So reserves is actually something you have to consider. So in my class, it's called Honest Answers to Top 10 Questions Asked by Homebuyers. And when I say honest, I really mean I'm going to tell you what I'm thinking, right? If you come to me wanting to buy a house with no money in the bank, I'm thinking you're an idiot. That's really what I'm thinking. I'm thinking, are you serious? You're going to try to, even when you go and rent a new place, you have to have first and last month's rent and maybe a deposit of some sort, right? You have to have some sort of funds if you're going to come correct to lease a home or lease an apartment. It's going to be even more so with a home. So you can't show up to a lender or real estate agent or to anyone selling a house and say, hey, I want to buy this house. I make plenty of money. I have great credit, but I ain't got no money in the bank. Right? I make plenty of money, but I have no money in the bank. Something doesn't add up there, right? You're spending more than you're making or something, right? I mean, if you make so much money, how come you don't have a savings, right? So again, it's not all about how much you make and what your credit scores is also how much do you have prepared for the cost of the home, and of course what you have left over to show financial strength, right? So I say 10%. Why? 3 to 5% for down payment, right? And 2 to 5% for closing costs. Like the ones that are without taxes, I said about $2,000 to $4,000, and then you have to worry about taxes and escrow and insurance, yada yada yada, depending on the size of the home, depending on the cost of the home, depending on the area of the home, depending on HOA, depending on all sorts of stuff. So I literally say 3 to 5% down and 2 to 5% for closing costs. But let's just make it easy and add 5% and 5% and say 10%. So you're going to buy a $400,000 house, $40,000 is probably a good number, right? Now that is what I tell people before this crazy market. This crazy market changes things, okay? And that's what I'm going to talk about in the next slide. But before I do that, I'm going to see if there's any questions or anybody wants to ask a question. Look in the chat. There's no questions. Does anybody want to unmute and ask a question? Excuse me. I'll make sure that everyone's in here real quick. Anybody? Is everyone sleeping, or did I just do an amazing job of explaining everything and therefore there's nothing for you guys to ask? I'm looking at actually you guys can see it too. I'm looking at the group here. Everyone could be hiding, including me, because my camera doesn't work. Any questions? Alrighty. Okay. So I'm going to go ahead and go to the next phase of this class, which is the phase that I'm excited about, because I kind of bored you with what I think you probably could have found online, or if your lender was willing to take the time to break it down for you, you would understand. I'm going to talk about the cool part. I call it the bonus, right? The deep dive information about money needed in order to buy a house in today's market, right? And let me sort of get a little bit more detailed about what I'm about to talk about for the people who don't know what's going on with the market. And when I'm talking about people who don't know what's going on in the market, more than likely you're not a real estate agent. You're a home buyer that found me somewhere. You don't know, you've been, hiding under a rock maybe. But right now the market is insane. And what I mean by that is there's a lot more buyers than there are sellers. There's a lot more people looking for houses than there are homes available. It's called a seller's market, right? So what's happening is that a lot of these homes are getting multiple offers, and probably 99% of the time, the offers are above asking. So if there's a house listed for $400,000, it's probably going to get an offer above $400,000. Okay, in a buyer's market, which most of us, I think, might be used to. Well, actually, it depends on your age and whatever. In a buyer's market, you could actually make offers who are, you can make offers that may be below asking because you're trying to negotiate. You're trying to be like, okay, well, you want to sell your house and I'm interested in it, but I'm only willing to buy it if you're willing to give me this or lower the price by this or whatever, right? That's a buyer's market. And the seller's market is like the exact opposite. It's more like, okay, I want to buy your house. I'm going to give you, $20,000 above asking. I'm going to pay for your kids' college tuition. I'm going to deliver food to you every single day for the next year, wherever you move to, even if it's Alaska. And I'm going to guarantee that you'll never be sad again in your entire life. Those are the kind of offers that are being put out there. Okay. So I know it sounds ridiculous, but I'm telling you, I've heard some crazy stories about what people have offered in order to win the house. Okay. And I'm talking about people giving up their commissions. And I mean, it's just insane. Okay. So, and what, like trips to Disney World? I mean, I don't know. I'm not a real estate agent. I don't make these offers. So I can't tell you what is right and what's wrong and what's not. I just heard stories and it's just insane. Okay, people are offering their firstborn child in order to get a house. Okay, that's what's happening. So I created this part of the class to sort of help with that scenario. Okay, so I want to give just a few ideas. Okay, from a lender's perspective. Okay, number one, you can actually increase your buying power if you were to pay down debts, eliminate your liabilities, and lower your DTI. Let me repeat that a little bit slower, but I want to just kind of get it out there. You can increase your buying power by paying down debts, eliminating liabilities, and lowering your DTI. If you don't know what DTI is, it's debt to income ratio. Look it up. I actually have a class that I talk about it. I'll probably link it somewhere. If you're watching this on YouTube, there'll probably be a link on YouTube to that class. Okay. But basically what I'm saying is that let's say you are applying for a mortgage right now and you have a certain amount of liabilities, car notes, credit cards, whatever, and you're trying to buy this much house. Well, your DTI is maxed out, so you can't qualify for this house. You have to buy a lower house. But a lot of the reasons why your DTI is maxed out is because you have these other liabilities. So if you have funds, and again, we're talking about money to close, right? How much do I need to buy a house? How much money do I need to close? If you have extra funds, you can actually work with the lender to find out what liabilities you can pay down to lower your DTI and therefore qualify for more house. Okay. And for most lenders and real estate agents, this is actually an obvious tactic, but a lot of people don't know about this tactic, especially when I introduce it. Okay. Like I'll say, hey, why don't we just pay this car off instead of you putting 20% down, put 10% down, and then take the other 10% and pay off the car. And now you can actually make an offer on the higher house. Right. And they're like, what? I can do that? Yes, you can do that. Yes, absolutely. 100%. You can do that. Right. And we actually assist you with that. Right. And people who are upgrading, they're selling one house to buy another house. Right. We can actually facilitate that process. We can be like, okay, you're going to make $100,000 on the sale of your home after you sell it and pay off the mortgage and whatever. So let's take 50,000 of that and put it towards the down payment, and take the other 50,000 and pay off this bill, this bill, this bill, and this bill. Therefore, freeing up your liabilities or eliminating liabilities and increasing your DTI. So therefore you can afford more house. Okay. We can facilitate all that. Okay. And in fact, I actually insist that if you're thinking about paying down any debts to qualify, whether you're doing it for this purpose or for any purpose to increase your credit scores, whatever, I insist that you talk to a loan officer first and have them look at your liabilities, because you might be paying down the wrong liabilities and you might actually lower your scores or hurt yourself or make no impact, and therefore basically spend all that money for no reason. Okay. Yes, you want to pay all your debts. That's cool. But let's be strategic about it. Let's be surgical about it and pay down the correct things that will give you the most bang for your buck when it comes to qualifying for a house. Okay. Which leads to my next suggestion: increasing your credit scores. Okay. A lot of people might know this, but I've talked to a lot of people who didn't know this. If you pay certain debts, you can actually increase your credit scores, because a lot of people's credit scores are affected by utilization. Okay. And there might be another term for it, but you can probably look that up. Credit card or credit debt, or, whatever liabilities, utilization. You'll probably look that up and it'll explain really simply what it is that you're doing. You're being docked points on your credit report if you have a certain amount of utilization. So there's probably like tiers. If you have it at 0%, at 5%, at 10%, at 25%, at 50%, every tier that you cross over will dock points from your credit score. And the way I can explain that or prove that is when I pull someone's credit, I see their scores from Experian, Equifax, and TransUnion. Actually, not in the order. It's actually Experian, TransUnion, and then Equifax, right? And I see their scores, and then I see under it potential score improvement. Okay, so they provide that on every report I've ever seen. Okay, so they give me the score, and they give me the potential credit score improvement. That potential score improvement is literally their way of saying this person lost these points because they have too high of credit utilization somewhere, right? The amount of buying power in terms of the credit they have versus the amount of debt they have, it's higher than we like it to be. So what it tells me is that if we can lower the utilization, then you actually will get those points back. That's what it means by potential score improvement. Okay. And if your lender doesn't do this, you probably need another lender. But I actually, whenever I look at a credit report, I actually look at the credit report and look at the potential score improvement. If I see any type of improvement that's easy to do or something that the client is capable of doing and willing to do, I actually will provide them a credit plan, tell them what to pay down, or tell them what we should pay down now, right? So that we can get a rapid rescore, meaning we ask the credit reporting system to update the scores based on the new balances because they were paid down, and therefore get higher credit scores. And why would you want higher credit scores? Well, number one, you might get a better rate. Better rate means less monthly payment you're paying towards interest, right? Which means you could buy more house, right? Another reason why you might want to pay down debts, obviously, for what I said earlier, eliminating liabilities, so therefore it's not part of your DTI. But some loans, when I say loans, I'm talking about loan products, they will actually give you more DTI buying power if your scores are at a certain point. So what I mean by that is, if I put your loan into the underwriting system and it says, the DTI is too high at, let's say, a 620 credit score, right? If I somehow help you get your scores to a 650 because of the strategy that we employ, it actually might improve because your score is above a 640. You know what I'm saying? There's no hard or fast rules. Some lenders have what we call overlays, which is an artificial expectation or limitation created by the company or the organization or the lender, but it's an overlay. So it's not across the board. Every lender has the same limitations. It's just that particular organization has that. So, I mean, I don't want to name any banks or lending institution, but there's some banks who won't look at anyone below 640. I can go down to a 580. Okay. But they won't look at anyone. They'll say, yeah, you're denied. We can't help you. But that's not because they don't qualify. It's because that is specific lending institution is not willing to help anyone below 640, right? That's their overlay. Okay. So why am I bringing this up? Well, depending on who you apply with, maybe your increase in credit scores can get past that overlay, right? But also not just for lending institutions with overlays, but in general, the automatic underwriting system that's ran by Fannie and Freddie, they might not like a file or a loan amount at a 620, but they might like it at a 650. So that's why increasing credit scores can actually help you, not just with a better interest rate, but you actually might clear a tier of some sort where you can actually get more buying power. Okay. And of course, the best way to do that, or the really only way to do that to see, is to do a rapid rescore. Okay. Rapid rescore, meaning you actually get a credit plan that I would provide for you. You actually pay down what you're supposed to pay down, or whatever it is they ask you to do. Sometimes it's not paying stuff down. Sometimes it's getting a new credit card. Sometimes it's removing yourself from authorized user or whatever, right? There's certain things that they tell you to do that can increase your credit scores. Once you do that, and I request for a rapid rescore from the credit reporting company, and they give me a new credit report with the higher scores, I can put your loan application into the system again and run it and see if we can actually get more DTI or a more house, which means more DTI. Okay, so that's the second suggestions we can do to buy more house using funds. Okay, because more than likely, in order to get better credit scores, if there's potential score improvement, is it's going to require paying stuff down. Okay, so maybe instead of putting 20% down to avoid mortgage insurance, you actually might be better off taking a large chunk of your funds. So instead of putting 20%, you might put 5% down and taking that 15% that you were going to put down towards your house and paying off debts to get your scores better. So therefore, you actually can buy more house, get a better rate. You might have to pay mortgage insurance, but let's do the math. Is it better to put 20% down and be subject to a worse rate, or is it better to put 5% down and get a better rate, right? And of course, more down payment, you might get a better rate anyway. So you really have to do the math. So it's almost like there's plus and minuses on both sides. Okay. And a mortgage consultant should actually be able to provide you those comparisons. Okay. All right. So my final suggestion, which is a little bit more creative, they call it outside the box thinking, whatever, is you might have heard it before, called the Appraisal Gap Strategy. Okay, so let me break this down for you in a summary, and then I'll kind of outline what the steps are. A lot of people are paying 20% down to avoid mortgage insurance. It's just a thing, right? It's almost like they're sensitive to it. Like they don't. It's like a principle. I refuse to pay mortgage insurance because mortgage insurance sounds good, but it's really not for the benefit of the person buying the house or the borrower. It's for the benefit of the lender. It's almost like a fee or a guarantee that if you were to default, then they get a certain amount, whatever. That's what mortgage insurance is. It's designed to protect the lender, not the borrower or buyer. So a lot of people don't want to pay it because it's not to their benefit, right? So they're determined to put 20% down to avoid mortgage insurance. Okay. Now that on paper and in general sounds like great financial decision making, right? A good way of thinking, right? But there are some instances where that might be not the right or best route to take. For example, let's say instead of putting 20% down to avoid mortgage insurance, you put 15% down, right? And now you have 5% extra to play with. And that extra 5% could be reserved just in case the house doesn't appraise, right? So let's say you're buying a $200,000 house and you offer $20,000 over, right? So it's $220,000 and the house only appraises for $210,000, right? So now you got to make up for $10,000, right? Well, there's your percentage that you took out, right? So even though you might not be able to put 20% down to avoid mortgage insurance, you can actually have the funds to pay for overages, and you might pay for mortgage insurance for a little bit of time, right? And actually there's prepaid mortgage insurance, meaning instead of like spreading it out on top of all your payments until you reach 80% loan to value or having 20% equity, you actually have a fee, one-time fee that you can pay. And that fee actually might not be that high, right? It actually might be something you can cover easily because you have the extra funds to do that. So the important thing is figuring out how much cash to close do you want to put down and what you want your monthly payments to be. Okay. You might still be able to achieve the same monthly payments and be close to around the amount of cash that you want to put down by sort of moving the funds around a little bit, right? Because again, why do people want to avoid mortgage insurance? Because it's an extra fee. And by principle, they don't like it, right? But it might be worth it to pay a little bit of mortgage insurance. And if you can pay it up front, it's even better because it doesn't affect your mortgage payment, right? But you have the extra funds to buy more house, meaning making more aggressive offers, right? And just covering the fee it costs to pay for that smaller amount of mortgage insurance, because you might have a little bit if you're only putting 50% down versus 20% down, right? Which of course has no mortgage insurance. Of course, you're putting 5% down or 3.5% down or whatever. Well, with FHA, you're always going to be paying mortgage insurance. There's exceptions, but that's another class, right? But for conventional, you put 5% down, of course, you're going to pay the maximum amount of mortgage insurance, depending on your rate and your scores and everything else. But if you can put, maybe not the full 20%, but maybe you put 15%, 17%, maybe even 19%, whatever it is, the extra percentage that you have might be enough to cover the appraisal gap, right? The lack of value that your appraisal wasn't able to provide, right? And there's examples I can give you, but the mindset is, instead of putting it all down, just avoid mortgage insurance, you can have some down and some for the overage that you must pay for because the house didn't meet value. And if you think about it, you can come at the offer either way, right? You can be like, Mr. Sellers or Mr. Listing Agent, whatever. My clients are going to put 20% down, but if there's a necessity for them to cover any overages because the house isn't appraised, we've actually have a strategy where they have enough funds to cover any overages and still qualify and still be happy and still be able to close with no issues whatsoever, right? So it's almost like you're offering a little bit of peace of mind to the sellers and the listing agent that I have plenty of funds. I intend to put 20% down if the house appraises. If the house doesn't appraise, that's okay. I already have a plan, a strategy where I will still be able to use the funds I have to cover the overages and still be comfortable with my monthly payment and comfortable with how much I'm putting down. So no matter what, I'm covered. Obviously, the ideal situation is you have so much money, it doesn't matter what the overage is, which I think a lot of California buyers are like that, right? But we're talking about people who barely have 20% down and maybe a little bit more for closing costs and whatnot, right? There's a way to sort of shift the money around so that you can still get the same cash to close in the neighborhood of the same cash to close. So there's not like overages that they have to pay for, that they have to come up with more money. They're just shifting the money around and still have the same monthly payment that they're comfortable with. Okay. So again, it's called the Appraisal Gap Strategy, right? So does anybody have any questions or comments or anything that they want to share? Because I'm pretty much done. And it's about 2 minutes before the hour. Has anyone ever heard of the strategy? Have anyone ever used this strategy? Okay, so I think this is Henry. What if the client doesn't have plenty of funds? Well, again, we're talking about how much do you need, right? How much do you need to buy a house? If you don't have plenty of funds, then good luck. That's all I gotta say, right? I'm just being honest here, okay? I'm talking about people who are trying to figure out how much money they need in order to not only close, but to win offers, right? I'm giving you the answer. If you don't have the funds, then good luck, or hopefully you get lucky. So I guess that's having good luck, right? But yeah, that's the answer to your question. If they don't have plenty of funds, then they just have to get lucky and find a house that they can offer on, and maybe they need to lower their expectations or lower their price point, right? So they can still employ the strategy, but at a lower price point. So instead of buying a $200,000 house, they're buying a $150,000 house, and I'm using lower numbers. I mean, in my market, it's more like 400,000, 300,000, whatever. But, instead of buying a $200,000 house, you're buying a $150,000 house, but you're prepared to pay 200,000 because of the insanity, right? But you have the funds to cover all that, because of course, if you can buy $200,000 house and have, enough to put 20% down, whatever, then you definitely have enough to pay the overages and still have a good amount down for $150,000 house, right? So that would be my answer, I guess. If they don't have enough funds, then they need to lower their price point, right, in order to employ these strategies. Otherwise, they're limping in, and again, good luck with that. Anybody else have any questions or comments? All right. What about takeaways or ahas? Does anybody have any takeaways or ahas that they got from this class? Is there something that maybe you learned today, or maybe was your favorite part of the class? I'm just trying to make sure you guys are alive. That's all. See, I'm so glad that I'm going to edit this on YouTube, because it's kind of embarrassing if I ask a question and it goes like a whole minute and there's no answer. People would probably like close my YouTube video, right? Or if I put like a clip of crickets, right? Maybe that will make them laugh and make them stay. No questions. Okay. Well, I really appreciate you guys being on this call. And hopefully you did learn something today. Hopefully you got something out of it. Hopefully whoever signed up for this class, whether you're a real estate agent, loan officer, or maybe a home buyer, this is information you could use to empower yourself and, make stronger, more aggressive, more competitive moves. Oh, actually, someone asked the question. Hold on. Oh, Georgia says, thanks. Great presentation. Thank you very much. I really appreciate the feedback. So yeah, like I said, my goal or my job or my mission is to empower you guys out there so that you can kick the competition's ass when it comes to making offers and preparation and whatnot, right? I provide TBD or to be determined pre-approvals. That means I will underwrite you without a property, right? That way, when you make an offer, you can offer with a loan commitment in hand. Day one, there's no need for a 21-day wait. You have the loan commitment in hand. That makes you competitive. That makes you stronger, and that makes you more aggressive. And you can actually close faster and actually offer closing faster on your contract. So again, things like that. This information is all designed to make you a lot stronger, a lot better, and again, be able to kick the competition's ass. Is someone asking a question? Sorry about that. No? Okay. Well, again, I really appreciate you guys being here. If you have any questions, give me a call anytime or text me 832-606-2193. My email is lle@vandyckemortgage.com. You can go to larrylee.com. There's some cool freebies over there. Or you can just Google me. If you forget all that, Larry the Mortgage Guy, and you'll probably find me. I really appreciate you guys watching, and I will see you guys later. This is Larry the Mortgage Guy, your mortgage insider. I'm going to do that again. This is Larry the Mortgage Guy, your mortgage insider. I'm out. Yep, thanks guys. Appreciate it. I'll see you guys later. 12:03, not bad.